Well, fears about the health of this economy have many people out there wondering exactly what to do with their own money, and that's where our next guests come in. Ann Sonders, Chief Investment Strategist for Charles Schwab, joins us from Stamford, Connecticut. Ann, risk on, risk off. This has gotten people confused, driven a lot of people out of stocks, even funds, mutual funds, and into government bonds because they're perceived as a safer option. Is this a smart thing that people are doing, and should more people be doing it?
Well, I think it really depends on who the people are we're talking about. I think too often prescriptions are given for investors as if they're all one and the same. I think it depends on where you are on the risk spectrum, what your tolerance is for risk, what your time horizon is, all of those things, tax brackets. So there's no one right answer to say, yes, you should be moving out of equities. We know that outflows out of equities have been huge. In fact, bigger this year than in 2009, believe it or not. And there has been a bias toward the fixed income side. I just think there are things you have to be very wary of and mindful of if you are plowing a tremendous amount of money onto the fixed income side of the ledger. It is not without risk. Doug
Flynn, I think, has a similar opinion. He is a certified financial planner and the founder of Flynn Zito Capital Management. Doug, you help people come up with their portfolios, and you think that there should always be fixed income or bonds in people's portfolio, but there's a common belief that owning bonds is less risky than bond funds. Is that true?
Not necessarily. The problem with individual bonds are that most people buy them to try to hold them to maturity. And you don't really get as much out of them as you would if you looked for the optimum time to sell them. They sort of peak and then they go down in value. And so a professional money manager, what they'll often do is they'll take some profits along the way. Most people don't think of that when they're buying their bonds. So sometimes a professional money manager in a fund will provide that for you.
All right, Ann, I think what you're both saying here is that these are not necessarily, there aren't large prescriptions, but back in 2008, it seemed like a large prescription would have worked for most people to get out of stocks. You're not thinking that we're in that sort of market now, even if we have some rough months ahead of us?
Well, of course, in looking back, we're all brilliant armchair quarterbacks after the fact. I think there probably is, at least in the short term, probably a little more momentum on the fixed income side, but I think investors ought to be considering taking some profits along the way. Much as Doug said, active managers do of bond funds. I think individual investors holding even individual bonds can do the same thing, take some profits, maybe shorten maturities a little bit, at least in the treasury portion, so that they can react a little bit more quickly. But also, there's always the importance that should be emphasized on diversification. We think of it, I think, more. Go ahead.
Ann, do you think you can build a defensive portfolio out of stocks today? And when I say defensive, I mean one in which you prevent big losses, but you actually might get some gains, because even in tough economies, even in recessions, with very few exceptions, that you can gain somewhere.
Well, prevention, if you mean eliminating all losses, that's not very easy to do unless you're talking about hedging with options. But certainly you can build a defensive equity portfolio. And some defensive names right now are offering some decent dividend yield. I wouldn't invest in a stock purely for a dividend yield. In fact, sometimes a high yield can signal problems with the company. But you do have that opportunity to bank the yield, which in many cases is higher than on the fixed income side, while also having the benefit of potential capital appreciation.
Doug, do you agree with that philosophy? And if so, are there places geographically or by industry that you think people should be considering increasing their allocations of rather than decreasing and sitting it out?
On the equity side, Ali?
Yeah.
Absolutely. I mean, if you look at technology versus utilities for a second, everyone still thinks utilities is a very safe place, but actually technology is undervalued relative to utilities. So you have to know your own risk tolerance, as Ann said, that you have to know individually what works for you. Adding technology may or may not work for you, but if you're already well diversified, that might be a space, if you're overweighted in another area, where you could trim some profits and move to another area that's undervalued. So there's certainly opportunities out there.
What about, Ann, should we be diversifying more into those types of things that we think of as defensive or as hedges, like precious metals or investments in other countries?
Look, I think Doug made a good point, which is defensive characteristics can mean a lot of different things. And I think one of the mistakes investors make is they invest based on the label of things. So they think defense and they think, well, therefore I need to be in utilities or consumer staple stocks. But defense can be given by looking at low valuation, where the greatest opportunities are. So I think you have to go beyond the labels and judge defense in terms of things like diversification, where the opportunities are, where valuation is reasonable. And that can come in sectors, and I would agree technology being one of them, where you may get some defense because growth is high and valuations are low, that maybe comes in an area that would not be classically defined as defensive.
All right. In other words, you can't be lazy about this and just sort of say, I'm throwing my money into X geographical part of the world, X industry. You actually have to do some work. That work can be done. Doug, how much of it needs to be done by people right now? Are there ways to put your money into certain types of funds, or do you really just have to sit down and have this conversation or learn what you're investing in?
I think it's more important now. People need to do a little bit more homework. So you could make the argument that the individual bonds are a little bit less of an opportunity because most people are not going to do the work necessary there. So a manager that's doing this every day should be bringing you value. But you have to look, staying away from treasuries right now. So many people have flocked to it. The yields are so low. You're going to get more opportunity right now by taking a little bit more risk and being a little more diversified, even in the fixed income space. We talk about diversification a lot on the equity side, but not a lot on the fixed income side. So flexible income funds, that's a category you can look up. That's where you're giving the manager the opportunity to go to different things like floating rates and other types of opportunities. That's where you want to look.
And strategic income funds as well?
Strategic incomes, those are the same category. They're interchangeable, but those are the ones where you can go to global bonds, you can go to, they can stay in treasuries to some degree. But look, the Barclays aggregate right now is 75% government bonds. In 2007, it was 25% because of the changes to Fannie Mae and Ginnie Mae. So if you buy a fund that just copies the Barclays aggregate, you're getting 3/4 government bonds in there. That's probably not where you're going to get the next opportunity. That's yesterday. So flexible income gives you, it's a little bit more risky, but it gives you more of an opportunity, and the yields are much higher.
Okay, I get from both of you that we're just going to have to keep on doing work, and people are going to have to do a little research into what they invest, but do it. Might pay off for you. Doug Flynn of Flynn Zito Capital Management, Ann Sonders, Chief Investment Strategist at Charles Schwab. Thank you to both of you. We'll be talking to you both again, I'm sure, quite regularly. The city of Philadelphia telling bloggers pay up or shut down. We'll explain why after the break.